Revenue is noise. Ratios are signals. Measure what keeps your business alive. Many business owners only look at revenue, but high sales do not mean the business is healthy. A company can grow revenue and still struggle to pay bills. Today, we will focus on the numbers that truly show financial strength. Financial statements have many numbers. Ratios help us understand relationships between those numbers. Instead of guessing, we can see patterns. This makes decisions more structured and less emotional. All important accounting ratios fall into four categories. Each one answers a different business question. Liquidity: can I pay bills soon? Profitability: am I getting enough? Efficiency: am I using resources well? Solvency: is my debt sustainable? If we understand these four areas, we understand the financial position of the business. Liquidity shows whether the business can handle short-term obligations. The current ratio compares the current assets with the current liabilities. If this number is too low, cash flow problems may appear quickly. Liquidity problems kill businesses faster than profit problems. Profitability shows how much money the business keeps. Gross margin tells us how efficient we are after direct costs. Net margin shows what remains after all expenses. Revenue is important, but the margin tells the real story. If revenue doubles but margin shrinks, growth is fake. Efficiency. Efficiency ratios measure how well resources are used. For example, receivables turnover shows how quickly customers pay. If payments are slow, cash flow becomes tight. Improving efficiency often improves stability. Efficiency improves liquidity without increasing sales. Solvency. Solvency focuses on long-term structure. Doubt, debt to equity shows how much the business depends on borrowed money. High debt increases risk, especially during slow periods. These ratios are important before expansion. Healthy solvency supports expansion. Don't calculate ratios once and forget them. Ratios only create value when they are tracked consistently, not calculated once and ignored. Review liquidity every month to stay safe in the short term. Monitor profitability trends to protect margins. Check efficiency quarterly to improve cash flow movement and assess solvency before making expansion decisions. Always compare trends over time instead of focusing on a single number. Consistent tracking builds financial discipline and leads to smarter, more consistent decisions. Revenue shows growth, but it doesn't show stability, efficiency, or risk. Ratios reveal whether your business can pay its bills, keep real profit, use resources wisely, and manage debt safely. If you start with only one area, start with liquidity. Cash flow problems quietly damage businesses before profits do. Track consistently, focus on trends, and use the data to make confident decisions. Thank you very much.